The US is about to borrow $1.1 trillion in just months, but the world is starting to step back, and if buyers refuse, yields could explode and the entire system could crack. And here's the real question. How do you know when an empire is under pressure? It's not when the stock market is green, it's not when politicians smile on stage. You know things are fragile when diplomacy gets dropped, when cooperation turns into intimidation, and suddenly the strategy becomes fight everyone and force them to accept it. Because this week at the Davos summit, we saw one of the most bizarre geopolitical financial movements in a long time. Trump made Greenland the headline, not just as a territory, but as a long-term strategic asset. And reports showed he pushed the idea of a Greenland framework involving NATO, basically creating a permanent US-style military presence on the island with no clear limits and the excuse missile defense, a so-called Golden Dome concept framed as protection against threats from China and Russia. But let's be honest, this is not only about defense, this is about money. Because Greenland isn't just ice and snow, under that land there is wealth, rare earth minerals, fossil fuels, and precious metals. And the US doesn't want China or Russia getting there first. That's the game. But here's the problem. Greenland isn't a free shopping mall. Even NATO leadership doesn't have the authority to give away Greenland. Denmark matters, Greenland matters, politics matters. And there's another issue no one talks about. Can the US even afford this? Building military systems, mining projects, ports, logistics on frozen tundra. Costs explode fast. So this entire Greenland plan could become a big Davos gamble that collapses later. And Europe knows it. But while Greenland grabbed the headlines, the real fear for Washington is happening quietly in the background. US Treasuries. Because right now global investors are getting tired of being forced into one system, and we are seeing a new message coming out of Washington. Don't sell US assets or else. Yes, you heard that right. The US Treasury Secretary Scott Bessent was asked a direct question about Europe dumping US stocks and bonds. And the answer was basically, if they do it, there will be retaliation. And the US has all the cards. Now think about how insane that sounds. This goes against free markets completely. Imagine telling the world you are obligated to buy our debt and hold it forever. And if you sell it, punishment. That sounds less like investing and more like control. And then a real event happened that made this even more serious. A Danish pension fund announced it would exit US Treasuries about $100 million worth. Now 100 millions won't crash America, but that's not the point. The point is what it signals. Because once allies starts stepping away from US bonds, it's no longer only China and Russia. It becomes something bigger. It becomes a confidence problem. And confidence is the only thing holding the debt system together. Because foreigners hold a massive chunk of US public debt, around 32% according to multiple estimates, which equals to trillions of dollars. And if just a portion of Europe and China dump treasuries, yield can spike violently, bond prices collapse, and suddenly the US debt machine starts choking. So the real question is no longer about Greenland. The real question is what happens when the world stops funding America like an unlimited credit card. Because once that trust breaks, everything changes. Now here where it gets even more serious, because during the same Davos discussion, Scott Bessent tried to downplay the idea that Europe dumping US bonds even matters. He brushed it off like it was irrelevant, but at the same time reports showed he was paying attention to analyst warnings, including fears that Europe could reduce exposure to treasuries. So which one is it? Is it irrelevant? Or is Washington secretly terrified? Because one thing is clear, the selling is not just a theory anymore. Denmark is a perfect example. At one point, Denmark's treasury holdings were close to $25 billion, but since around 2016, the trend started shifting. They were not buying the same way anymore. And over the last year, the drop accelerated, with reports claiming billions sold off. And that's the keyword, trend. Markets don't break because of one seller. Markets break because once a trend starts, everyone asks the same question. Should I be next? And now think about this. If Europe keeps reducing treasury exposure, it becomes a nightmare scenario for the US. Because the US needs interest rates to come down. America's debt system doesn't survive high rates forever. But if global investors sell long-term bonds, it pushes yield higher, and long-term yields are the ones that matter for the economy. It affects mortgage, corporate borrowing, government financing, everything. And here's the number that should shock you. In the first 2 quarters of 2026, the US government is expected to borrow around $1.1 trillion from the market. Not from printed money, from real buyers, from investors willing to lend America their savings. And estimates says that roughly $158 billion more than the same period last year. So let's simplify it. America needs more money at a time when trust is weaker, and that is not a comfortable combination. And yes, the US may collect income through tariffs, but tariffs don't replace borrowing, not even close. Because the spending machine is still running at full speed, and if military expansions becomes a priority, that means even more borrowing ahead. Now add one more piece of the puzzle. The US 10-year yield has been hovering around 4% plus, with the discussion mentioning around 4.2%. And if you understand bond math, you know what that means. Borrowing at 4% plus is expensive when you are drowning in debt. And the scary part is this, even if the Federal Reserve cuts rates, it may not fix the long end of the curve because central banks and big investors hold longer duration bonds. So if they start selling the long end, the Fed cannot fully control that. And that's when you get the nightmare situation. Short-term rates fall, but long-term rates stay high. And long-term rates staying high is how economies cracks, read by read until suddenly it snaps. Now here is the part the markets are not ready for. Besant was asked if Europe or the UK has any financial retaliatory tools, and he basically said no. Like Europe has no options, like they'll never respond. But that kind of confidence can be dangerous. Because if past and history shows us anything, when powerful nations feel cornered, they don't always choose the smartest move. Now major banks are already talking about something that sounds extreme, but is not impossible. The US could sanction entities that dump treasuries, meaning punish sellers through the financial system. What could that include? Locking institutions out of US banking access, cutting them off from dollar settlements pathways, restricting transactions with American companies, and in the worst case, freezing assets. That's how OFAC style financial warfare works. Now imagine the message that sends to the world. You can't sell US bonds safely. That's not just market manipulation. That's a global trust earthquake. Because maybe the US can trap money today, but what about the future? Who will buy tomorrow and who will lend again next year? Because the US can't fund itself once, it must fund itself forever. And the moment global investors realize that treasuries come with political risk, the market doesn't need to collapse instantly. It just needs to become more expensive, more fragile, and more unstable. And at that point, the question becomes unavoidable. If the US needs $1.1 trillion soon, who will lend it when the entire world is starting to rethink the deal?